Foreign investors have withdrawn a record $15 billion from China between April and June, according to data from the Chinese Commerce Department. Foreign direct investment, FDI, in China has been declining since it peaked at $344 billion in 2021. If this trend continues throughout the year, it would mark the first annual net outflow since 1990. The slowdown in China's economic growth, rising geopolitical tensions, and trade disputes with Western nations have prompted foreign companies to reduce their exposure in China. The country's rapid transition to electric vehicles has also caught foreign investors off guard, as local companies receive substantial subsidies that foreign firms struggle to compete against, leading them to scale back their investments. Last year, China experienced its lowest FDI levels in 30 years. In the last 3 years, Chinese stocks have lost a record $6 trillion. Investors are withdrawing due to both short-term and long-term risks in the Chinese market. The European Union, EU, is increasing tariffs on Chinese electric vehicles, EVs, to discourage imports and boost local production. Chinese companies face a 37% higher tariff in the EU compared to other manufacturers. After unsuccessful negotiations with the EU on the issue of tariffs, China has filed a complaint with the World Trade Organization. The EU argues that China's significant subsidies to local companies result in dumping cheap EVs in the European market, creating an uneven playing field. For investors, this situation represents a significant risk. Today, it's China versus the EU. Tomorrow, it might be China versus the US, as both presidential candidates in America have signaled intentions to restrict Chinese imports.
And if they don't agree with us, we'll put a tariff of approximately 100 to 200% on each car, and they will be unsellable in the United States. We have long been taken advantage of by other countries.
During his previous term, Trump took a hawkish stance by imposing substantial tariffs on Chinese products, a rare step that was followed by the Biden administration. Additionally, the Chinese economy is under stress and failing to meet its targets. China set a growth target of 5% but is expected to grow at only 4%. Chinese exports, projected to grow by 9.7%, are increasing by just 7%. Given these challenges, foreign investors find it increasingly difficult to maintain a presence in the Chinese market and are exploring alternative opportunities in neighboring countries.